Okay, so now we are going to talk about mortgage payment calculations. And this is somewhat of a real life scenario if you think about it. At least in the US, where you are given these long 30-year fixed mortgages, fixed rate mortgages, it's somewhat of a mystery to some people why we are making the payment we are making, or how do we arrive at that exact number that the bank arrives at. And well, let's read this problem and then we'll talk about some of the complications here. That it is not a simple straight compound interest problem. There are some nuances to it, and all this can be solved but it just we have to set up the problem correctly. So let's read the problem first. So Julia had signed up for a 30-year mortgage, fairly common in the US, to purchase a new house. The bank has loaned her $1 million. I'm just picking a simple number here, but it could be more or less. 1 million is quite a lot of money. At a rate of interest 5% annually compounded. Now this is an important detail because sometimes these loans are annually compounded. Rarely they are daily compounded, but more common is monthly compounding. What that means is that you accrue interest, and at the end of 1 month that interest is added to the principal, and for the next month the amount that is calculated is based on, or rather the interest is based on the previous month's total principal, which is the starting principal plus the interest for the first month, assuming that there is no payment. And she has to make these payments starting 1 year from today, which is also fairly common. Well, the interest payments are usually monthly, or even the mortgage payments are usually monthly, but I'm taking yearly so that just we simplify the numbers sufficiently, but also not so small numbers that the calculation becomes trivial. So that's why we have a 30-year the loan tenure, and we have annually compounded and annual interest and principal payments, but we are not going to the monthly level. It might just be too complex for a video of this duration. Yeah, and we want to make 30 equal payments so that at the end of 30 years the principal and interest are fully and exactly paid off. Now this is the complex part. So what is our annual payment? So let's take smaller numbers. We don't want to immediately jump the gun and solve this problem in its full glory. Let's solve a simpler problem first. So before we even start solving the problem, let's understand what is happening. So there are 30 equal payments that I want to make starting 1 year from now. And in this 1 year, so I have this $1 million loan. Julia has this $1 million loan. So at the end of 1 year, it will be 5% more. That is 1 million and $50,000 more. Now she has to make a payment on that amount. I don't know, let's say it is a $60,000 payment. So her principal remaining at the end of 1 year would be 1 million plus 50,000 minus 60,000. That is the payment she has made. So it's about 990,000. Looks like a little small, but that's how it works usually for these long term payment mortgages, that you are for the first few years you are paying mostly for the principal, mostly paying for the interest, and very little part of the principal comes off. And then later, once you reach the closer to the end of your term, most of the payment goes towards the principal and very little goes towards the interest. But the trick here is to find that exact number. There is just one exact and only one correct number, that you make a payment at the end of 1 year and the principal reduces somewhat. Then you make another payment at the end of second year and the principal reduces even more, and so on. And after your 30th payment, the principal and interest and everything is exactly paid off. And that looks somewhat of a daunting task. So how do I come up with this number? And this looks like there is no obvious way to land on that number. So we have to set up the problem. So let's read this. By the way, so there are more complications that I have not considered here. For example, there could be early payments or prepayments. Usually it happens that if you sign up for these mortgages, there is usually no penalty for prepayment. But I can, so what does prepayment mean? She does not have to make equal 30 payments. She has to make that at the minimum. But if she has more money somehow, let's say she can pay more, then she can start dumping that money into her loan, and that will reduce her principal amount. And then she will have to make less payments and less interest payments. That is one complication that is not considered. Second is, so these 30-year loans are commonplace in the US, but other parts of the world, maybe Canada or Australia, they are not that common. And there is what, at least in Canada, I'm aware, there are what are these called ARM. ARM is adjustable rate mortgage. They are also available in the US, but in Canada they are more common. That so the interest rate remains fixed only for the first 5 years or first 7 years and so on, and then it changes. There are rules for how to change that interest rate, but we are not considering that. I mean, that makes the problem harder, but it's again solvable. But that's not our focus right now. So we have this specific setup, and let's understand what is happening here. Before we go into the actual solution of this problem, let's start with a simpler problem here. So I'm going to solve a simpler problem first that tells us what the ingredients of the solution are, and then we will solve the real one. Simpler problem. So instead of, so the term of the loan is only 2 years, let's say, not 30 years. So now I have to make only two payments, two exact equal payments. That is, at the end of 1 year, there will be one payment. At the end of second year, there will be another payment. And that's it. I'm not going to make any additional payments. So that's number one. And another simplification that I'm going to make is number. I mean, just let's take a smaller number. So principal is, let's say, just $100. Not 1 million. This is just so that we get a smaller number and a simpler number to work with, rather than a somewhat complicated and larger number. So now can we solve this? So let's say my payment, the unknown amount, so payment at the end of 1 year, at the end of 1 year, let's call this amount x dollars. So what do we know about x? Let's try to write an equation in terms of x. So I'm going to also draw what is a free cash flow diagram, but we'll come to that. Let's first start from the first principles. So let's see what happens at the end of 1 year. So my principal has grown. So principal plus interest is equal to $105, because 5% interest rate, and it has grown for 1 year. My principal is $100, so principal plus interest at the end of 1 year is $105. I'm going to drop the dollar sign just so that it does not bother the actual calculation, but always keep it in your mind that the numbers that I'm writing are in dollars. Okay, so the principal plus interest is 105, and what happens then? So then there is a payment of x dollars. So remaining principal I'm going to write it in quotes because it is part of the principal plus interest that is remaining, is 105 minus x. And so what do I know? 105 minus x times 1.05 is equal to x. Why is this? This is the principal at the end. This is the remaining principal, and this is the 1 plus interest rate, and this is the payment at the end of second year. So the remaining principal times 1 plus interest rate, which is what the principal will grow to, has to be equal to the final payment, because we started with the assumption that x is the amount, x is that magic number, that if I make at the end of first year and at the end of second year, if I make a payment equal to x, then my loan is completely paid off and there is no additional payment. So it must be the case that the principal plus interest at the end of first year, when I multiply by 1.05, which is the amount to which it will grow at the end of second year, exactly equals my final payment. Otherwise that there is no balance. The cash flow balance will be off, will go off. So now we have a simpler looking equation. This is a linear equation in x. It turns out that all the equations in this video are linear in x. X is the unknown amount, but it's just that they are somewhat complex to figure out. So what do we know here? So I'm going to write it purposefully as 100 times 1.05 times 1.05 is equal to x plus x times 1.05. I'm bringing this x times 1.05 to the right hand side, and I'm going to write this 105 as 100 times 1.05 and times another 1.05. So if we simplify, what do we get? X is equal to 100 times 1.05 square divided by 1 plus 1.05. It turns out if you crunch the numbers, just for completeness, I am going to write this. The actual value is x is 53.78. Again, everything is in dollars. So for this simpler problem, it is you have to make equal payments of $53.78 at the end of first year and at the end of second year, so that the principal and interest is completely paid off and there is no extra payment. So this also passes our sanity check, because if we were to only make a $50 payment, let's say, at the end of first year, then what would happen is an amount equal to $55 would be left, and then whatever I do at the end of second year, if I were to make only a $50 payment, then it will definitely not even going to cover even the principal. But I see that we are getting close, right? 50 is roughly the right amount, because if the interest rate were 0, then I would have to make 2 equal payments of $50 each. So now I have to bump it up slightly more, but I have to bump it up by a precise amount that covers the interest payment of the second year as well. So that's the non-trivial part of it. Now let's take another look at what is happening here. So I'm going to call it's a free cash flow diagram. Free cash flow, or the FCF diagram, and this will probably give us a better idea of what is happening. So it starts with a 0. It goes in one direction here. So this at time 0, I'm going to take a loan for $100. At the end of first year, I'm going to make a payment of X dollars. End of second year, I'm going to make a payment of X dollars. I'm dropping the dollar symbol as mentioned, just so that it does not become unnecessarily crowded. So what is this free cash flow diagram? This is a timeline, and I'm recording events here that are going to involve any transfer of money. So at time 0, I get $100. At time 1, I'm giving out X dollars. At the end of time 2, or at time 2, I'm giving out X dollars. Usually in these free cash flow diagrams, so the positive numbers are written, the payments to me, the payments to the person who is drawing the diagram are written with an upward arrow, and the payments that are known to be negative, this X dollars is going out from me, right? So this is a cash that is leaving my pockets, so that is represented with a downward arrow. It doesn't matter, this is just convention, this is just notation, but you can draw a vertical arrow of minus X if that makes you happy. Or in other words, sometimes what happens is the positive or negativeness of this number X is not known, in which case we just assume that I'm getting X dollars and I draw it with a vertical arrow, and if it happens to be negative, it happens to be negative. That's fine. This is so this is showing me the different cash flows that happen throughout the system at different times. So at time 0, I'm getting $100. At time 1, I'm losing X dollars. At time 2, again, I'm losing X dollars. And so the objective is to find out what this X is and what is the purpose of this diagram. What is this showing me? So the numbers on the further right, you have to understand that these are happening at a later time. So in the free cash flow diagram, the numbers on the left are usually more valuable than the same numbers on the right, because there is interest involved. So this number X that we are saying here is X dollars at the end of 1 year, but because of interest payments, they are not as valuable as if I had a value amount equal to X at time 0. The money on the left grows with the interest rate. So this $100 at time 0 would be equal to $105 at the end of 1 year because of the 5% interest rate. Or if the interest rate is R, then it would be 1 plus R times the starting value. So let's see what happens at at time 0 here. So what the bank has loaned me $100, and I have to give the bank $100 back. I have to give the bank today's $100. I cannot give the bank tomorrow's $100 because money today is worth more than money tomorrow. So one usual thing that people do in these diagrams is bring all the numbers back to 0. So as I explained, so when I want to bring this number x back to 0, it has to be divided by 1.05. And when the second x has to be brought back to 0 at time 0, it has to be 1.05 square. Either that or another and equivalent approaches, grow all the money to the just after the last point here. So here, move all the money to this point at or slightly beyond that point. So let's draw another diagram here rather than complicating the first one. 100 x 1 and 2. I want to bring all the money at time 2. So this 100 comes here as 100 times 1.05 square. This x here comes as x times 1.05, and the second x remains as x. So either way, whichever way you look at it, let's look at the second approach, that I'm going to bring all the money to the final point here. The bank has loaned me $100 2 years ago. I have to return the bank $100 or equivalent of $100 today. So we know that, therefore at time 2 all the balances have to be exactly 0. So 100 times 1.05 square is the amount that the bank loaned to me, has to be equal to the amount that I give to the bank at the end of second year, which is x times 1.05 plus another x, which is x times 2.05. So again, if I rearrange, I will get x is equal to 100 times 1.05 square divided by 1 plus 1.05. And if you remember, this is where did it go? This is the exact equation that we solved here. Let's call this equation star. This is the exact equation that we solved. So that's what is happening. The bank has loaned me $100 as of a certain time, and I want to return the bank $100 as of that certain time. I don't have that much cash today on hand. I have to buy the house, but based on my future income or whatever else, I will be able to make that payment in the future. But because I'm not making the payment today, I'm making the payment in the future. That's where the interest rate comes in. That in the future I have to pay you more money, and that's what this free cash flow diagram is showing in another way. So now let's come back to the original problem. But the original problem is much simpler now that we have all the ingredients and this free cash flow diagram. So what does this diagram look like here? This is a starting payment of 1 million from the bank, and I'm going to make, or Julia is going to make 30 equal payments. 30, or rather this is x, 1 2 3 30. She's going to make 30 equal payments. This is at time 0. The bank has given her $1 million. So what is the value of x that solves this free cash flow diagram? So we know that, so this principal, I'm just going to introduce some notation here. Principal is $1 million. I'm going to drop the dollar. Rate of interest is 0.05, which is same as 5% per year, per annum. I'm going to introduce a notation G, which is the growth rate, which is basically 1 plus R, which is 1.05. So if you start with $1, this is the amount to which you will grow at the end of 1 year. This is just a convenient notation to define because there will be many terms with 1 plus R. So I'm going to call it G. So by our free cash flow balance equation, let's balance everything at the end of 30 years. So left hand side is just principal times G raised to 30, because this 1 million grew to 1 million times 1.05 times 1.05 30 times. And right hand side, let's start from the very end and let's move backwards. X plus this, at the end of 29 years there was an x here, so this grew to 1.05 times x, or g times x, at the end of 1 year, starting at the year 29. X plus xg plus x g square plus, how many terms are there? There's exactly 30 terms, we know that, x g raised to 29, because at the end of first year to the end of 30th year there is 29 years in between, which is x times 1 plus g square plus all the way to g raised to 29. This is looking somewhat complex, but it is not, just bear with me. So I have to have LHS is equal to RHS by the free cash flow equivalence. So this P times g raised to 30 is equal to x times 1 plus g square all the way to g to the power 29. Maybe I'll make another separate video on this, but there is a way to, this is a geometric series, and because the ratio of consecutive terms is a constant, which is g, so just take it on faith right now that this is equal to g raised to 30 minus 1 divided by g minus 1. So what do we have here? X is equal to P times g raised to 30 times g minus 1 divided by g to the power 30 minus 1. Again, this is looking somewhat complicated, but it is only slightly more complicated than usual. It is just multiplication and division of a lot of numbers, but this is all simple, straightforward linear equations. So I plugged in the numbers here, so this turns out to be $65,051.44 or something. So Julia has to make this payment, this annual payment to the bank every year starting next year for 30 more years, so that her interest and principal and everything is completely and exactly paid off at the end of 30 years, and there is no remaining balance, and she's also not under any debt. So a few things to talk about this. So it looked somewhat harder than usual, so that's why maybe this video is also longer. But let's run a couple of sanity checks here. So is this amount correct? Does this amount look correct? So if the interest rate were 0, what would be my payment? So that's $1 million, 30 equal payments. So that would be around how much would that be? So that is roughly $30,000 of payment, right? 30,000 times 30 would be around 900,000. Let's say around $33,000. That would be the payment. But what we are saying here is we are seeing a much bigger number. We are seeing $65,000 and whatnot. We are seeing a large payment here, and that is to be expected in these kinds of situations, that you are paying a lot for the privilege of owning the money today or owning your house today, because the interest payment, if you think about it, if you just scale up these numbers, this is $65,000 times 30. That is the amount, that is a dollar amount that you're going to pay. I understand that these dollars are not today's dollars, because the dollars in the future are going to be worth much less than what they are worth today. A dollar today is worth way more than what it would be in 30 years. But just looking in terms of dollar amounts, it would be this 65,000. Let's say it is 60,000. 60,000 times 30 is 1.8 million. So on a $1 million home, you are paying 1.8 million, and that $800,000 roughly is all interest. That's how the bank is making money. You have to realize that it is not today's dollars. These $800,000 that you're paying are over time, but that's the time value of money. And that's what shines through here, that a larger principal payment today will make your life much easier going forward. So if you can make prepayments, then your total dollar amount that you pay would be lower. That's the power of compound interest. You're paying almost twice as much the amount that you would otherwise pay, because you want to buy the house today, and $1 million today, you want that entire amount available today, which you don't have right now. That's why you need to take the loan. So this passes a sanity check, that I have to make way more than $30,000 or $33,000 in my principal and interest payments. Now let's run a second sanity check, that if I were to make perpetual payments on this, so there are these things called perpetual loans. Perpetual loan just means that I'm only making interest payments. Basically, there is no the amount of principal just does not drop at all. It's just a perpetual payment. So what that means is this is what the cash flow diagram looks like. So let's say this is $1 million, and I'm making these payments X until the end of time, basically. So what does this mean? That I can the reason I'm making all these infinitely long payments is because my payment is exactly equal to the interest, and the amount of principal just does not drop at all. And so what would that be? So let's see. So left hand side is again, so now I cannot take everything all the way to the last point. I have to bring stuff back to the first point, because there is no point at infinity that I can bring. So left hand side is 1 million, and right hand side is equal to now x divided by g plus x divided by g square plus x divided by g cube. This is an infinite series. I have to add all these numbers up, which would be x times 1 by g plus 1 by g square plus, and so on. So we know that, well, we don't know that, I know that, and I can show you in a later video that this infinite series sums out to be x times 1 by g divided by 1 minus 1 by g, which is x times, if I take this g to the numerator, 1 divided by g minus 1, which is r, x divided by r. So this is left hand side is 1 million is equal to right hand side, which is x divided by r. So x is equal to $1 million times rate of interest is 0.05, which is $50,000. So if I were to make only interest payments and not any principal payment at all, then I have to continue paying $50,000 no matter what. And then at the end of 1 year, therefore I have only paid off the interest portion and no principal has been touched. So in the end of second year, I have to again pay $50,000, and third year again $50,000, and so on. So it makes sense that the real answer, the true answer that we got, $65,000, has to be more than this pure interest payment kind of situation, because I have to cut down that principal at least somewhat by at least say in our example $15,000 at the end of first year. Otherwise I'll keep making payments with in perpetuity. There will be no end to my payments. So there are few more things that we can consider in a real life situation. So sometimes, and as is common in finance, that there is continuous compounding. We have talked about in this example that there is annual compounding, but there is also this concept of continuous compounding, that the interest that you got from the last millisecond also become part of the principal, and for the next millisecond or for next small amount of time you have to again pay interest on that interest, and so on. So those kind of questions are also not hard to answer. It's just that you need some more sophisticated math to handle them. But so that's one thing to consider, that, and it's very common, and it's not at all far-fetched, where the interest rate is continuous interest. And second is now we can talk about, now that they're just making the problem slightly harder, complex, is 360 equal payments, that is 30 years of monthly payments. You can use the same techniques to handle such problems. So this is somewhat of a longer video. This is almost 28 minutes, but I think it was well worth it that we spent this time to understand these details in sufficient granularity. All right, talk to you next time. Bye.